the delusion that most investors have had for the last almost 10 months now of, oh, it's okay, it's recovering, it's a bottom, et cetera. If that disappointment sets in and they, desperation again, they say, oh my gosh, I fooled myself, what did I do, et cetera. That's when you get your second phase of the bear market, the implosion of the biggest stock market bubble in US history.
On today's episode of What the Finance Podcast, I have the pleasure of welcoming back Michael Oliver. He's the founder of Momentum Structural Analysis. So, Michael, thanks for coming back on the podcast today.
Good to be back, Anthony.
Yeah, and I really look forward to speaking because, as I was saying, we just had a quick conversation then. But since our last conversation 7 months ago, a lot has happened. It's crazy how much can happen during that period. I know last time you were talking about sort of you thought bonds were going to do quite poorly, and then there was this massive asset bubble as well. But maybe you can go over those things, and then also, what are the major, I guess, macro trends or trends that you're currently watching to see next steps of the market?
Okay. Well, of the two major assets in the U.S., among U.S. investors especially, are the stock market and the bond market. There's this notion of the 40-60 balance portfolio, where 40% in bonds, 60% in stocks. Well, last year, you were wiped out on both of them, down 30% plus in T-bond prices, long end of the U.S. government bond market, and muni bonds and high-yield corporate debt as well. And in the stock market, you were down 20 to 30%, depending on which part of the market you were in. So it was a horrible year for that notion of a balanced portfolio. It didn't work. The only thing that was unchanged and steady last year, and it didn't get heralded, was gold. Gold closed the year unchanged from where it closed 2021. And silver actually closed the year up a couple percent from where it was at the close of 2021. Since then, they've gone up a lot more. Gold's back making new highs, and silver has broken out. Okay, now back to the big assets again. When we talked last, I thought bonds were going lower, and they did. Into October, they dropped sharply further. Okay. But I think that October low last year in the bond market was probably the low, at least for a good while. And the T-bonds have since bounced off that low, not major bounce, but enough to be noticeable, and then stalled. Over the last couple of months, they've stalled. Our technical assessment is that probably the T-bonds are going to continue higher in price, lower in yields over a good chunk of this year, let's say. We don't think it's going to be a big move. We think it might be a 10% price move in the T-bonds, which when you look at the charts, you got to realize that what T-bond futures just did in the US, or the TLT ETF just did last year, they collapsed from, we had a sell in late 2020 before the stock market even topped. They collapsed all the way back down to the price levels they saw in 2009. So that would be like the US stock market, the S&P 500, instead of dropping from where it was at 4,800 high, it'd be down about 1,500 right now, or 1,000, if it had matched what T-bonds did. So T-bonds got wiped out. They crashed. They paid big dues. Okay. We tend to think that all quote alternative of the T-bond market will in fact provide some stability for the rest of this year for people who move money over to T-bonds. You'll maybe even get a 10% gain, which is not a big deal when you look at the charts. You're not going back to the highs or anything in price. So, but it's stability. We think that the asset bubble breakage of the stock market, though, has only still just begun. And we thought the first phase of the bear market would be what we called an arm wrestling match. And sure enough, it has been an arm wrestling match. Meaning, we have a drop into June of last year, pretty serious drop. You dropped from, S&P went from like 4,800 plus down to 3,500. Okay. NASDAQ 100 went from 16,600 down to almost 10,000. Huge drop. And since June, they've done this. Plenty of teasing rallies that when you look at them up close, you think, oh boy, this looks great. But if you stand back and go back to the June low, for example, in both markets, and then they made a marginally lower low in October. But if you just go back to that June low, it was a rally into August last year. We're still in between the low of that June price low for those two indexes and the rally high they made in August. So what we've done is we've just had redundant, repeated rallies that have gone really nowhere. All they've done is hold the market steady. And largely because a few big name, heavily weighted stocks like Microsoft and Apple in particular, and also the semiconductor sector, which got the hell beat out of it last year. It had a 50% drop. And so it was deserving of a big rally. It got wiped out big time. And so those prior beat up stellar performers or heavy weighted symbols, especially Apple and Microsoft, they're so heavily weighted that I don't even know why they call it the NASDAQ 100. You could find about 4 stocks that comprise about half that index. Okay. But they've had a good rally. Not enough for us in our analysis to call them bulls, but to call it an impressive bear market rally. But when they fail, and we think they're close to rolling over again, I think the sentiment is going to go out of the market. And the delusion that most investors have had for the last almost 10 months now of, oh, it's okay, it's recovering, it's a bottom, etc. If that disappointment sets in and they, desperation again, they say, oh my gosh, I fooled myself, what did I do, etc. That's when you get your second phase of the bear market, the implosion of the biggest stock market bubble in US history. And let me define that. From the 2009 low to the 2021 high, S&P went up 7-fold. NASDAQ 100 went up 16-fold. You can go back and look at the 29 peak, the 1973 peak, the dot-com peak, the 2007 high. None of them were of that dimension. And yet we even label some of them. Remember the dot-com, we call it a bubble. Heck, it was only like a triple. NASDAQ just went up 16-fold, okay? There's no comparison in history. And if you look at the Fed funds chart during those years, 2009 to 2021, we took rates to zero and kept them there, okay, effectively. And money supply growth was incredible. So there's no wonder we had a bubble like that. The problem now is it's broken. This is not a normal bear market, and people who treat it as such are making a big mistake. They don't see the context.
And why is this not normal? Like, just because what you said there, that there's those massive, I guess, 4 or 5 companies propping up basically the whole stock market, or are there any other things?
Oh yeah, in fact, it's demonstrable. I mean, you could go back and see that the gains a week or two ago, we had a good gain in the S&P. It was almost entirely attributable to Apple. And in the next week, it was attributable entirely, you could weight it to Microsoft. In other words, had they not gone up, the broad markets would have gone down, okay, because most of the components were negative except for those heavily weighted symbols. So the question is, when those guys go, hope is going to go out the window, because that's where the hope is attached to, very narrow few symbols. Banks were another example, US banks in particular. Back in January, if you looked at the bank sector, and we did, they were pushing up, having a real good rally high. In fact, they were stronger than the S&P. And in fact, unlike the S&P and the NASDAQ 100, which in fact made lower lows in October of last year than they did in June, the banks didn't. They didn't take out their June lows. So they were less weak than the broad market. And then when we had that rally late in the year into January this year, the banks were stronger. So one of the sectors that probably attracted a lot of hope and sentiment and buyers was the bank sector. Well, it was a trap. And we put out 2 reports in late January, and we said, watch out, there could be an ambush here. This is a great behaving sector, but don't trust it, because the technicals argued it was ripe for breakage. Well, it did break. In fact, the bank sector went from the KBE, which is an ETF of US bank sector, went from 51 to 31 between the January high and the March low. That's a crash, okay? And it's still laboring. And it's not just because of 1 or 2 regional stocks or anything nonsense like that. You can look at a chart of, let's say, take the 4 or 5 big US banks that are too big to fails, Wells Fargo and Bank of America took out the 2022 lows, just like KBE ETF did, and just like the regional banks did. Nobody focused on that. They didn't note that two of the big five were taking out the 2022 price lows. That'd be like the S&P dropping down to around 3,000 or something. Okay. Citicorp is barely above those lows. Okay, so you got three of the big banks really looking sick, technically speaking now. I'm not saying there's any story that's going to come out or anything like that. There's no worry about them failing. We know that because the Fed will print the money. We know that. They're too big to fail. So that's not an issue. The issue is whether this false narrative that it's one badly managed bank, a third badly managed bank, instead people are going to realize, hey, this is something worse. So anyway, watch that arena as well on its failure to come back, for example. But we think that the stock market's about to go into its next dive. And I think that is what has been driving the monetary metals. Because the monetary metals have been around longer than the stock market. Several thousand years we've had gold and silver as money in the world, okay? They don't wait for the news to cause them to move. They anticipate trend events. It's almost always the case. Why was it that last year when the Fed was, quote, tightening rates and going to, quote, fight inflation, that the victim was the stock market, not gold? Why didn't gold go down last year? It had a brief down last summer, a false downside breakout that we call the bear trap, where it took out a bunch of flat price lows, went 3% more, and then immediately took back off to the upside. Why did gold have a net change, unchanged year, 2021 to 2022? And why is it now at all-time highs this week? Yet the Fed's fighting inflation, right? Well, they are. They're fighting inflation. They created an inflationary paper asset bubble, and they have broken it. And it's going to come undone more. And when it comes undone more, and you see the real world in the street consequences of that coming undone, the revelation of the errors that families made in their financial planning and corporations made and cities made in their spending plans and federal government made in its spending plans, all based on the assumption of free money. And not just an assumption that was underway for a year or two, but a dozen years. I mean, if you doubted that you would keep getting free money, pretty soon you didn't doubt it, okay, because it lasted, so long. And therefore, you made decisions based on that huge economic assumption. And now suddenly rates have gone to 5% in the Fed funds rate, and credit is getting harder to get. We're going to have a credit crunch. There's no doubt about it because the banks are tightening up. And so suddenly everybody's in debt more than they ever have been. Corporations in debt more than governments more in debt. And what is the unraveling of this going to do to the central banks? We know what the answer is. They're going to have to revert to what they do and what they were created for, which is to underpin the debt markets by printing money. Or, and if it's not a rate issue, which is the headline, what's the Fed funds rate? Watch the balance sheet. Because while they curtailed the balance sheet, it dropped. They pumped a lot of assets into that balance sheet from 2020 to 2021, especially when they were buying stuff during the COVID crisis. Then they got rid of a lot of it. It suddenly started back up sharply. So we know what they'll do when they have to do it. There's no limit. And I think that's what gold knows. And I think gold knows that this is an historic event. It's the unraveling of the biggest paper asset bubble in U.S. market history, especially U.S. history. We don't have a similar situation in China. There's not a bubble. Its price level versus like where it was in 2009 is only double. Even the European markets, if you look at most of the European indices and compare it to where they were, let's say in 2015, they're really not a lot higher. So most of the bubble was in the US. And so that's where probably most of the percentage pain is going to be. Hence, the Fed is going to have to be the one that's the loosest. Anyway, so it's a story that we hold. We've been arguing it for over a year. We still hold with it. We think it's the biggest bubble breakage in U.S. asset history. the primary beneficiary will be gold and silver and related.
Yeah, it's crazy to think. And I know I've talked to a lot of other people and they talk about a similar thing where it's like if the Fed has to choose between recession or the currency, they're always going to, or, the economy, they're always going to go in and try and save the
Correct.
economy. So,
Right.
if we look at sort of, you've said there's almost been like a few false starts recently, it's hard to really know when that, I guess, fold over occurs. What are the key things that you're going to be watching to understand, okay, it's not just a false start again, it's potentially going to be this
Okay, well,
crash?
right now, our focus, we stressed this in our most recent momentum structural analysis weekend report, is you can look at Apple and not Amazon, excuse me, Amazon hasn't recovered. Microsoft and Apple, if you want, as your cheering points. But our assessment is that their rally is probably out of steam right now and is about to roll over again. If they roll over, that's going to be a sentiment breaker. Not to mention they're weighting within the NASDAQ 100 and the S&P 500 will be a percent weight on those indices. But we're also watching the broader financial sector. Here it's called the XLF, which is the ETF that covers, like American Express, asset management companies, insurance companies, not just banks, but, it's broader. It has not taken out the summer 2022 lows. It came down very close in March to those same lows. That would be like the S&P coming down to about 3,500 and stopping again. But, excuse me, XLF is just floundering with a flat floor that they keep defending either side of 30 points on the XLF. Right now it's trading about 32, 33. We think if it goes back down again, much under 31, you're probably going to blow that floor. And what that will say is that sector, which is like 12% of the overall S&P, the financial sector, is going to take you down. And I don't care what Apple's doing or Microsoft is doing. If you take that financial sector through its price lows of last year, momentum will have already broken those lows. There's no hope. Forget it. You're going down. You will follow the financial sector down. Right now, it's narrower because it's just regional banks and then the bigger banks. KBE has also broken those lows. But the broad financial sector hasn't. So we're watching that. So really, if we had to just focus on, let's say, three symbols, it would be XLF, the broad financial sector, Apple and Microsoft. And we see those three things roll over, forget it. It's going down. The market's going down. All this effort for the last 9-10 months of buying and then it sells off, buying, then it sells off. It doesn't make new lows. It just doesn't go anywhere. Finally, they'll just give up. And that's when the sentiment goes right out the window very quickly. And I think at that point, that's when the central bank will get its data points. Most of the data points that the central banks look at are so lagged to reality. And also, usually they're lagged to the stock market. So it's not usually the case in a bear market in stocks that you see unemployment get real bad and lay off, all the negatives that you might want to look for. They don't usually happen at that phase of a bear market. They happen later. And so the Fed looking at those as if they're leading metrics. They're not. They're lag metrics. But they're going to get them because, you get that next phase down in the stock market and sentiment will go out the window. And put yourself in the position of, let's say, a CEO of a moderate-sized company. You're not an economic genius. You know how to make a given product. You've heard from guys like Jamie Dimon that this isn't going to work out well, head of JP Morgan, and other economists. But your company's doing sort of okay. You haven't laid anybody off yet, or you haven't, you've not hired anybody, but you haven't laid off. But you're debating. If you take that stock market down again, that will give them the answer and the clarity that they want. And so these guys that are the middle ground of the economy will start to say, gosh, my hope was unfounded. We better cut back. And that's when points will suddenly shift. And also we get a credit crunch, which is much anticipated and highly likely to happen now because of the fear among banks and therefore the need to tighten up and so forth. So, and overall, we think the next phase is about to occur. And when it does, we think the monetary metals are going to be the primary beneficiary. We also focused on the commodity sector because as the stock market has tried to rally, and it has rallied, moderately, over the last 9-10 months. What's the commodity sector done? Well, it's eroded to the downside. We had a massive doubling in the Bloomberg Commodity Index in price from the late 2020 low. We claimed there would be a commodity explosion at that point. It was October 2020. We put out a report, commodity explosion. Well, at that time, Bloomberg Commodity Index was 70. By early 2022, it reached 140. There was resistance up there that we predefined as an area where likely you would stall. Well, sure enough, it's now been since they peaked in March, 1 month after that war in Europe, okay? They peaked. So you can't blame the war for that because most of the move occurred in commodities way before the Ukraine-Russia event ever started. Since that event, you've had commodities erode back down, energy, grains, etc. Bloomberg Commodity Index right now is at 103. And that's only several points off of its low of its pullback. We think if it closes much over, we've got a specific number, I won't repeat it, but several percent above where you are now, you close out this month and the number adjusts down each month. You close out the month, we're going back up again in commodities. Now, what's so funny is that as the stock market has firmed, Bloomberg Commodity Index is corrected mildly, not sharply. So they're opposites. So a lot of people think, oh, if the stock market goes down and we go into a recession, commodities go down. No, stock market's been rallying, commodities have been going down. And our technical assessment is that commodities could turn back up here very easily. It wouldn't take a lot in terms of a percent upturn from where we are right now to restart the commodity engine again. We think there's another major up leg in the commodity sector. Now, we don't think it's going to be as strong as gold or silver. This is sort of like the late 70s, for example. You had gold turned up first off of its 1976 low, which was like $103 after it had been at 200. It had a 50% drop. It turned up from a mid-1976 low, and by 1980 it was $850. Eightfold move. Commodities also went up during that time, but they were lagged by about a year to the gold upturn. So gold has now come up off a low last September and is now actually intra-week produced a new high this week. Commodities are still under pressure. I think they're about to turn up and join gold. And so we think of the categories you want to be in. It's not the stock market, but it is commodities and commodity-related stocks. We focus this weekend particularly on copper, which looks ripe for another upturn. In fact, it made a low recently coincident with gold last September. And it's turned up nicely, but it hasn't gone back to its highs. It's gone about 2/3 of the way back to its high. But I think copper and the copper miners, the big ones, are ready to join in a powerful way on the upside in this next major commodity move. And you've got to remember that though they talk about how big the commodity quote inflation's been, it really hasn't been. Yes, year-over-year change has been dramatic. When you take an index from 70 and a year and a half later, you're 140 between late 2020, early 2022. That's a big percent year-over-year gain. So yeah, that was a big percent gain. But in price terms, even the peak we made in early 2022 at 140 on Bloomberg, you go back at 2008, it was 270. No, 236. And in 2011, it made a secondary high at about 170 something. So we're right now at 103. We're at less than half the price of the peak of 2008. So commodities still have just to get back to the highs of 2008, they got a long way to go. So they've got plenty of room to run, and we think they will. So again, the best place to be, I think, is going to be gold, silver, with an emphasis on silver, and secondarily in the commodity category again. I think copper is one area. Another would be grains that we like the most.
Yeah, it's fascinating. Are you looking at any other maybe physical assets, so I guess like real estate or anything else in that regard, or do you think that's a part of the bubble?
Real estate looks like it's part of the bubble. In fact, our assessment, we assess major ETFs of real estate in the U.S. XLRE is one, RWR is another, the real estate investment trust ETFs. And they look negative just like the stock market. and they've had a bounce just like the stock market. And I think they will go down with the stock market. So that's an asset that doesn't look. Now, farmland is an exception. Now, I would separate farmland out from, commercial and residential real estate for obvious reasons. Because if soybeans, corn, and wheat start a second leg up, obviously farmland is going to be much appreciated. But think in terms of real down-to-earth assets and stocks related there too, as the better place to be this coming year and probably the next year as well. And I also think that what's about to unfold is not going to be incremental. A lot of trends, bull trends in gold, for example, can be incremental in their advance. Like the last bull trend was 2000. In the year 2000, gold was about $250 and it went to 1920, but it took it a decade, 11 years. It went 2011 before it peaked. So, it had its phases, but it was like a very protracted bull market. I think the next part of the gold move could be very, very rapid, where over the span of a year, you might gain many multiples, and especially with silver. In terms of its percent gain relative to gold. I'm more on the chaos theory side now, that not an incremental arm wrestling match. We've seen that for the last year or so, but I think that's going to end because I think the events that we're talking about, fundamental and technical, about the bubble breaking, are so dramatic in their consequence that the market response to it will be snap. So if you're going to make a decision, better make it soon.
Yeah, definitely. So what, as you said, you've talked a bit about this potential bubble bursting. What would you be, so say if it sort of went the other way and it broke a certain, what level would it have to break on, I guess you could say, Nasdaq, S&P, other assets, where you may be saying, oh no, it's going to continue.
Our problem on that issue, and that's been asked by a few of our subscribers, like, what would make you bullish? Almost nothing. The problem is that from our mode of analysis, we look at price, but secondarily to momentum. Now, remember, here's the context. We got bearish on NASDAQ 100 in January of 2022, which was like a month off of its high. It had been 16,600. We got bearish just under 15,000. Right now, it's trading either side of 13,000. Which is a rally, by the way. It had gotten down closer to 10,000. We see nothing on the long-term momentum charts, particularly annual momentum. This is when we measure the price action of the index versus its 3-year average or 36-month average. That drop that we had last year, starting in January and February of last year, we got bearish on the major indices. That drop into June and then in October blew out so much support structure on annual momentum and at neutral type levels, meaning it's not oversold when it dropped that low. It was just breaking floors that went back 10 years on momentum that you couldn't see on a price chart. And all we've done since then in this time-wasting process is the momentum charts have flip-flopped around below the points of breakage on the momentum charts. And I don't see any structures overhead, meaning like major downtrend lines on momentum or flat ceilings on momentum, where if you could get above them, you could call it a breakout. And therefore, when momentum doesn't offer us a structure to break through to signal a new trend, we never assume that a new trend will emerge. And usually it never does. Usually a structure has to precede a trend change and a breakout through that structure. We don't have any such structures on the US stock market to break through to create a buy signal. So, and I think that's why the price action that we've seen over the last 9-10 months has been flip-floppy. It hasn't been dynamic. Oh, there's some dynamics within that, but they keep dropping back and then playing the same game again over the same price turf. So it's a time-wasting process. And I think that the clock is about to run out on the buyers, where you only get so many months to try to prove yourself. And they've been trying to prove an upward case. Well, I mean, either prove it or you don't. And as far as we can see, they're confined in the lower half or lower third of the price range of the last couple of years twisting and turning, with some sectors having blown those lows out, like the banks. So, and so if we now have the broad financial sector and Apple and Microsoft start to roll over again, then forget it. Okay. And I hear the question, because some people believe that, this is a bottom, it's a bottom. We don't see the technical wherewithal to generate that.
Yeah, that makes sense. So, Michael, thanks so much for your time today. I really appreciate it. So, my last question is, what is one message you'd like people to take away from our conversation?
Think broad, but focus on gold, silver, and the miners related there too. Those miners, by the way, are vastly undervalued by any metric, not just technicals, but by fundamentals, earnings, and so forth, to other stocks. And they look like, we've done studies of the relative performance of the mining sector versus, for example, the S&P. And we see enough evidence that's going on right now to argue that it's time to be buying miners and selling the S&P. You want to put on a spread, own stocks, short stocks, equal balance. Well, short the S&P, buy the gold miners. You'll probably make money on both sides. Okay. So I think the miners are a place to look at that is a vastly undervalued and likely to reassert itself arena that's related to the monetary metals.
Yep, great message. So thanks again for your time. So if anyone wanted to find out more about your work, would your website be the best place for that?
That's www.olivermsa.com. MSA stands for Momentum Structural Analysis. You can see a lot of information about us there. You could also request some sample reports. Be happy to send them to you. Thank you.
Perfect. Awesome. I'll put that in the description below, but thanks again for your time.
Thanks, Anthony.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.